Hi, I'm Guy Schwartz with Call GMS, and today's topic is real estate tax, specifically supplemental real estate tax, and it's applicable to California only. So if you're not watching in California, you'll learn how taxes work in California. Okay, so in California, the fiscal year starts July 1, and the tax year goes from, in this case, 2019 for the first installment to 2020 for the second installment. So July 1st through December 31st is installment 1, and January 1 through June 30th is installment 2. And the way you remember how to pay your taxes, the way they taught us in real estate school, is no darn fooling around. And what that means is your taxes are due November 1st, must be paid by December 10th, and then again February 1st and April 10th. And when they say no darn fooling around, they certainly mean that, because if you don't pay your taxes on time, it's a 10% penalty. Ask me how I know. I just forgot to pay them. So, in the industry, we use 1.25% times the sales price as a factor for an estimation. It's pretty darn close. Some cities are a little more, some cities are a little less. It depends on what they're adding to the tax bill. But for purposes of calculation and qualifying, we use 1.25%. You'll be pretty close unless there's Melrose. Now, let's talk about what supplemental taxes are. So in our scenario here, this borrower is purchasing a home August 15th. The tax rate currently on the record for this house it's based on $350,000 worth of value. That's how taxes are determined, based on the sales price. So their current tax base is $364.58 per month. If a person is purchasing the house on 8/15, the taxes are already set for the year at the old rate. So what's going to happen is when they close here on the 15th, the seller who owned the house from July 1 through the 15th is going to pay them back 1.5 months, or $546.87 in escrow. So on their closing statement, they'll see a credit for that amount. Now, eventually down here in November, they're going to have to pay the taxes that are due, which, let me switch over here, is $364.58 times 6, or $2,187.48, because it hasn't been adjusted yet. However, the county reassesses the value of the property, and in this case, they're paying $500,000 for the house. The county reassesses the value of the property from the day they own it. So from 8/15 to the end of this tax payment, which is December 31st, there's an additional or supplemental of $156.25. How did I figure that out? You have the old tax rate, this is the new tax rate, and the difference is $156.25. So the county wants an additional $156.25 for these 4.5 months, because this person, the new owner, is paying the old rate. And then coming over here for installment number 2 of the taxes, we have the $156.25, which again is the differential times the entire tax period, which is 6 months, so that's $937.50. So here we have $703.13 for the supplemental taxes, and here we have $937.50, and if we add them together, we get $1,640.63. Dividing that by 2, and for you math whiz, I know you're going to tell me it comes out to, it's a penny over, $820.32. So what happens? The county is going to send you a supplemental tax bill, and they're going to give you 2 chances to pay this differential of $1,640.63, and that's $820.32 on stub 1, and $820.32 on stub 2. Pay it on time, otherwise there's a 10% penalty. If you have any questions, give us a call. Kirk out.